Okay, hi. So today's lesson would be on International Accounting Standards. We call it IAS. So for under the A-level A2 syllabus, you need to know these IASs. There are 9 of them. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, so this is basically a theory subject except for one of the IAS where they have a simple calculation. Okay, so what is IAS? Okay, IAS stands for International Accounting Standards. Now, what are they actually? They are like concepts. We can think of them like a kind of framework and a guidance to show us how to deal with each subject matter in accounting the appropriate way, the approved way. Okay, so you need to remember the IAS number and the title, what the IAS says. Okay, so in an exam question, when you write the title has to be written exactly like, for example, presentation of financial statement. If you write presentation financial statements, you won't get marks. So it is safer to write the IAS with the number without even writing the title, which means to say if you write the title without the number, the title had better be exact. But if you write the number with or without the title, you still get marks. So safer, you just remember the number and what the IAS title is. Even if you don't want to write the title, put the number and explain what it talks about. So in exam questions, usually IAS, this topic doesn't, they don't ask a question fully on this topic, but this topic will be blended with other topics. Okay, it'll be blended with other topics, and you need to know to solve the situation, to solve the problem, which IAS number to apply and how to solve it. Okay. Okay, so IAS number 1, presentation of financial statements. So IAS number 1 talks about financial statements. So the financial statements that you have learned is the SOFP, okay? And here they mention SOCI, Statement of Comprehensive Income. Actually, this is the latest name for the Statement of Profit or Loss. In A levels, we call it Statement of Profit or Loss. But for those who are taking a degree in accounting or doing a professional course in accounting, they call this Statement of Comprehensive Income. It used to be called Income Statement, okay? But we call it SOPL, Statement of Profit and Loss. Okay, so this is your Statement of Profit and Loss. Okay, so and then you have the Statement of Cash Flow, which I taught you. So you have been taught the format of each of these 3 financial statements. So the format is such because to meet the requirements under IAS number 1, right? For example, under IAS number 1, the purpose of financial statement is to provide information to the users of financial statement as to the following details. Okay, financial statements can tell us how much is the assets owned by the business, how much liabilities the business owes people, and what's the equity, what's the income and expense, and so on. What's the cash flow? So these are all the information sought by the users of financial statements. So as you know, the assets, liabilities, and equity, you can get it from the statement of financial position. Okay. The income and expense, you can get it from the SOPL. And the cash flows, you can get it from the statement of cash flow. Okay. So a complete set of financial statements in accordance with IAS number 1 consists of a statement of financial position at the end of the period. Okay. And then a statement of profit and loss and other comprehensive income. Okay, and then you have a statement of changes in equity, which you know how to prepare. And then you also have a statement of cash flow. Okay, statement of cash flow comes under IAS number 7, yeah. And then accompanying all these statements, we have what is called the accounting policies and some explanatory notes. So these notes provide additional information on the financial statements. Okay. Okay, so the standard requires compliance with a series of accounting concepts. So IAS 1, see, since IAS 1 is about the preparation of financial statements, so generally financial statements are supposed to reflect the true and fair view of the state of affairs of the business. So which means the figures reported must be accurate, relevant, truthful, The value should be fair, not over underinflated. So in order for all these to work, the figures should be prepared in line with the approved accounting concepts. Okay, with the approved accounting concepts. So the accounting concepts that you have learned before, right, in AS, which is going concern, yeah, the accrual basis of accounting, right, where we match the revenue earned with the expenses incurred in the same period, right? Going concern is where we presume that the business is going to continue indefinitely until told so. And then we have the consistency concept. Example would be the way we calculate depreciation. So consistency deals with using the same method to calculate certain required figures every year. So if consistency is not being applied, then the figures would not be accurate, and when we want to compare yearly, last year, this year, or few years back, year-to-year comparison wouldn't be very accurate. Okay, and then we learned materiality. Okay, and then offsetting. Okay, offsetting means, like for example, you have, for example, cash at bank. Cash at bank can sometimes be a positive figure, sometimes be a negative figure. So the standard doesn't require us to offset. That means to combine both these figures. For example, if you have a $10,000 asset in one bank balance, and a $2,000 overdraft, you cannot combine these two and show as 8,000 assets. You must show the 10,000 under current assets and the 2,000 under current liability. Okay, so for example, it's not permitted to offset a bank overdraft with another bank account not in overdraft. That's what I mean. Don't combine them, but show them separately. What the one under asset you show as asset, the one under liability overdraft you show under liability. Okay, all right, and then comparative information. So this is a requirement to show the figures from previous period for all amounts shown in the financial statement. So for example, when you look at the SOFP, you see here, you must show this year and last year for comparison sake. So these are the requirements for IAS number 1. Okay, so IAS number 1 also defines how detailed the financial statements should be presented, right? So you've always been taught that you must have the name of the entity, and then for SOPL, the wording is standard. In fact, the wordings are all standard. You only change the year end. For example, SOPL, it's statement of profit and loss for the year ended, whatever year end. Okay, if it's a SOFP, statement of financial position at whatever year end. If it's a statement of changes in equity, statement of changes in equity for the year ended, whatever year end. Okay, likewise, if it's a statement of cash flow, then statement of cash flow for the year ended, whatever your year end is. Okay, so these are all the details required to be included in the financial statements in accordance with IAS 1, in compliance with IAS 1. Okay, a clear indication of the financial statement, whether we're talking about, I mean, you need to name the title, whether it's an SOFP or SOPL or SOCE or SOCF. Okay, name of the entity, and then the period, the financial period. Okay, okay, and then the currency. Okay, you must have the dollar sign or pound or whatever. Okay, okay, and then the rounding use. For example, if statements are prepared in thousands or millions, then accordingly lah. Like for example here, to save time, this is actually 100 million, you know, but because we are preparing in thousands, so we write as 100,000. But actually the value is 100 million. Yes. Okay. All right. So the format of how an SOCI, which we learn as SOPL, looks like is like this. Okay, you've been taught. So this is mainly for published accounts. Okay. We combine the total, the cost of sales, we just show total, and then all the expenses are grouped together, classified together under 3 categories: distribution costs, admin expense, and finance costs. Okay, So the profit from operation must be labeled clearly, less finance cost. Then you have profit or loss before tax. Then you deduct the taxation expense. Then we have, well, technically this is your profit for the year, and it's the one which is attributable to ordinary shareholders, or rather also known as equity holders. Okay. All right, so that's on IAS number 1. This is how a statement of changes in equity, the retained earnings column, looks like. So all that you have learned and you have been taught is because it is required so in the relevant IAS. Okay. So according to IAS 1, only dividends paid during the year are included in the financial statement, which means we only record as a business transaction whatever dividends paid during the year. It can be last year's dividend paid, or it could be interim this year's dividend. Whatever paid during the year, that's what we record as a business transaction. Okay. Proposed dividend is not, see you read here, proposed dividend is subject to approval. So we need to get the shareholders' approval at the annual general meeting. So therefore, proposed dividend is not recorded as a business transaction, but rather it is shown as a note to the financial statement. So they will include in one of the notes that a dividend is proposed. Okay. So no double entry yet for proposed dividend. It only becomes a double entry if the proposed dividend is agreed to be paid. Okay. All right. So in line with IAS 1, your SOFP must contain all this as what you have been taught lah. Okay. Right. So example of a statement of financial position. Okay. So you have your, okay, under the non-current asset section, you have to list down your intangible non-current assets, such as goodwill first, and then only the tangible non-current assets. So take note, under the published accounts, the tangible non-current assets are referred to as property, plant, and equipment. So property, plant, equipment covers all kinds of tangible non-current assets. Okay. So to see the detail of these figures, we need to refer to another schedule called the Schedule of Non-Current Assets that comes under IAS number 16. Okay, coming up later. Okay. So this is how. Okay, now let's move on to IAS number 2. So IAS number 2 talks about inventory. All right. So inventory, what is inventory? Inventory is well, to start off with, it's a form of current assets. It is resources which is purchased by the company with the intention of being sold, right? So IAS number 2 talks about inventory. So what do we know about inventory so far? Okay, this is one of them. Inventory exists in 3 forms, which is raw material, and then we have the work in progress, and then we have the finished goods. So the finished goods is either manufactured by the business or purchased from suppliers. Okay, right? So this concept has been taught to you under the chapter called manufacturing account. Okay, and then what else do we know? So IAS 2 says that if you have various forms of inventory, you need to separate them. You cannot mix. I mean, you need to show how much is raw material inventory, how much is inventory in work in progress form, and finished goods form. Okay. When we show them, when we report this under the current asset, you need to report separately how much is raw material, how much is work in progress, and how much is finished goods. Now, in terms of valuation, as you've been taught before in AS, so inventory is valued, the rule is should be valued at the lower of cost and NRV. So this is the requirement of IAS number 2. Okay, lower of cost and net realizable value. Here's an example of inventory valuation. Okay, the ABC Stationery Company bought 20 boxes of photocopier paper at $5 per box. So following a flood in their stockroom, 5 of the boxes were damaged. Okay, so they were offered for sale at $3 per box. So take note, the damaged inventory were offered for sale at a price lower than the cost price. Okay, so all were unsold at the end of the company's financial year. Unsold means they're still appearing as inventory in our books. So at what price would they be valued in the annual account? So they're asking you at what value should we value the inventory, the unsold inventory. Okay, so here's the thing. We have 20 units altogether. So we need to categorize these 20 units into how many good units and how many damaged units. All right. So from the 20 units, 5 units were damaged. Therefore, 15 units were good. So the ones which are good, you can value them at the usual cost price, which is in this case $5. Okay, since there's $5 is per box. So since we have 15 of them, so 15 times 5 equals 75. So the 15 boxes would be valued at $75. Okay. Now what about the 5 damaged items? They were offered for sale at $3. So which means the 5 boxes will be valued at $3 per box. So 5 times 3, 15. So total inventory value is 75 plus 15, which is $90. So whichever is lower, that's the value that we pick. Okay, another example. So the Good Look clothing company carries a variety of stocks. Stock is the old name for inventory, by the way. At the year end, they produce the following data. Okay, so you've got 3 kinds of inventory, namely new dresses, children's clothes, bargain fashions. Okay, so you're given the cost, the net realizable value, and the selling price when new. Okay, that means when not damaged. So what will be the total stock or rather inventory value for the annual account? So new dress. So now when you compare, remember you compare the cost and the net realizable value. So the selling price when new is irrelevant. So just ignore this column. So we compare this and this. So whichever is lower, that's the one that we pick. So comparing these two figures, pick the lower, which is 1,000 for new dresses. For children's clothes, whichever is lower, we pick, which in this case is 2,000. And for bargain fashion, pick the lower figure, which is 900. Then we total them up. This is the correct inventory value. This with the reasonable inventory value, the fair, value to be reported in the financial statement. Okay. So another reason why we pick the lower cost and net realizable value, not the higher, is because we don't want to overstate the value of our assets. Because overstating the value of assets would mean overstating the profit as well. So this is in line with the prudence concept that I've taught you during AS. That's the whole idea. Okay. Now moving forward, so we've talked about the various forms of inventory under IAS 2. We've talked about the rule on how you should value inventory. Okay, so now let's look at the methods of valuing inventory. So there are 2 approved methods. There used to be 3. Now this one is removed. Okay, so you only need to know these 2 methods: first in, first out, and average cost. Okay. Last time, LIFO was one of the methods, but now not anymore. Last in, first out. So you only need to know that these are the 2 approved methods for valuing inventory. Okay. So whichever method is chosen, the method should be used to value inventory every year. So which is where consistency kicks in, the concept of consistency. Okay. Changing our method would mean yearly comparison would not be meaningful. Okay, because the figures would then not be accurate and reliable anymore. Okay, so clothing inventory for a manufacturing organization. So a manufacturer holds, like, of course, obviously, manufacturer will need to separate inventory according to these three forms, as mentioned earlier. Okay, raw material, work in progress, and finished goods. Okay, so valuing raw materials. So the approved methods are FIFO or FCO. Okay. Now, this FIFO FCO is where we determine the cost of the raw material. And then, if necessary, we need to compare them with the net realizable value and pick the lower between the two. Okay. So valuing work in progress and finished goods. So, okay, in terms of work in progress and finished goods, we need to value them in terms of their elements, or rather, depending on how much is their percentage of completion. Okay. So both the work in progress and finished goods, we not only take the inventory value into account, but also the cost of converting the inventory into finished goods. Okay, so this is where the added cost, like direct expenses, direct labor, direct expenses, and the overheads and all that. Okay, that which means we include all costs to incurred to bring the product to its present location or condition. That is what we value as inventory cost. Okay. Okay. However, take note that these items should be excluded from the valuation of inventory. Okay. Abnormal waste, storage costs, selling costs, okay, admin costs. Right. Right. Now, let me just explain a little bit what is abnormal waste. Okay, that means I need to touch on normal waste as well. Now, waste. In the manufacturing process, you've got two types of waste. One is normal waste and one is abnormal waste. Okay, normal waste is where we lose the inventory along the way due to natural processes, which is fine, which we cannot control. Example, let's say our inventory is some form of liquid, maybe acid. Maybe we are producing acid. Okay, so acid is in liquid form. Okay, so for example, when we pour in two chemical elements and we want them to react, there might be chances that during the process of reaction, the mass of the mass of the liquid that we poured to mix up these two liquids, we might lose some of the mass. How? Evaporation. So that's something we cannot control because it happens as part of the natural process of the environment. That is normal waste, an example. Okay. Another example I can give you is, okay, if you have gone to stitch clothes from a tailor, custom make your clothes. Okay, when you walk into the tailor's shop, you would first, the tailor will give you a booklet. And from the booklet, you will choose which material you want to. Let's say you want to stitch a pair of pants. So they'll give you a booklet, ask you to choose which is the material you want to stitch the pants. Then you choose the material that you want, and then what the tailor will do is they will cut a little piece of the cloth from the main roll. So that little piece cannot be used to make any new pant because it's a small piece, and that is normal waste as well. Okay, any kind of waste that incurs in the course of the normal production process is normal waste. Abnormal waste refers to more of a wastage. Sometimes during the production process, let's say workers made a mistake. So when they make a mistake, they need to redo, right? They need to redo. So that means they need to, the one that they made a mistake cannot be used anymore. So that's waste. So they need to buy more material and redo. That's abnormal waste. Okay, so abnormal waste cannot be included as part of the inventory. Abnormal waste, storage costs, selling costs, and admin costs. Okay. Here's an example. Example, valuation of work in progress and finished goods. So the XYZ manufacturing company manufactures wooden doors for the building trade. So for the period under review, it manufactured and sold 10,000 doors. So at the end of the trading period, there were 1,000 completed doors ready for dispatch to customers and 200 doors which were half completed as regards direct material, direct labor, and production overheads. Okay. So the total cost for the period would be based on what is completed. Okay. And the value of work in progress, okay, the total units sold and finished goods unit 1,000. Okay. So half completed units. Here they say 200 doors which were half completed. So half completed means each of these 200 units are 50% complete. So if you combine them, it's equal to 100 fully completed units. So that's why you multiply by 50%. Okay. So these are the production units for the period. Okay. And this is the attributable cost. So the cost per unit will be the cost divided by the units. So $3 per unit. Okay. So you'll use that per unit to multiply with the units to get the value of the finished goods. Okay. Now moving on to IAS number 7. So IAS number 7 talks about statement of cash flow. Right. So statement of cash flow, as you've been taught, is one of the financial statements which deals with providing us with information on the cash inflow and outflow during an accounting period. Okay. So here we see cash as either inflow or outflow, right? And all the cash inflow and outflow are separated into three main activities, namely operating activity, investing activity, and the financing activity. Okay, so the requirements of this IAS is that we want to see these three main activities. Okay, so the format of the statement of cash flow is like how you have been taught. You got this section, profit and loss from operation, then all this. So this is just the operating activity. Okay, in this case, 52,000. Then operating activity plus investing activity. Okay, plus financing activity. So then you have to add them up. Because we also want to see the total during the year, whether it's inflow or outflow. Then we want to see the accumulated figure as well. So we need to add cash and cash equivalents brought down. That's why this is a total of three activities. Then we add the cash and cash equivalents brought down to the three total activity during the period, and we get the balance at the end of the period. So this figure should tally to your cash book, or rather by looking at the statement of financial position, it should tally to the cash balance, cash and cash equivalent balance shown in the SOFP. Okay. So IAS 7 allows some flexibility. So what it means is, okay, interest and dividends received and paid. Okay. You can choose to show them under operating activity or investing activity. But in order not to confuse everyone, I teach you all, follow the way I've taught you all. Okay. Interest or dividend received will be shown under investing activity. Interest or dividend paid, we will show under financing activity. Interest paid, we will show under operating activity. Okay. So cash flows arising from taxes on income are always classified as operating activity, and so the taxation paid will always be shown under operating activity. Okay, so far we've learned IAS number 1, which talks about the presentation of financial statements. IAS number 2, which talks about inventory. And then we learned IAS number 7, which is on statement of cash flow. Okay, so now let's head on to IAS number 8. So this is the title. IAS number 8 deals with accounting policies changes in accounting estimates and errors, mistakes. Okay, all right. So this standard is designed to formalize accounting policies within an organization to standardize. Okay, accounting policies, what are they? So they are like bases or rules and regulations applied consistently in preparing the financial statements, right? For example, if the business foresees that a loss is going to happen, although not officially happened yet, we need to provide an estimate for the amount. So this should sound familiar to you. I'm talking about, as an example, irrecoverable debts. Irrecoverable debts is when the losses have already happened. We already know the person cannot pay us. But sometimes customers, when we call them for payment, they seem to be giving excuses. So although it's not proven that you cannot collect the debt, it's not proven that it's irrecoverable yet, but it's going towards that direction. So we need to adjust for allowance for irrecoverable debt. I mean, we don't wait for the actual loss to happen. We tell the users of financial statement, look, this is a possible loss. So what if our estimate is not accurate? That doesn't matter. Every year we will review and we will adjust. So that's why you have some years you have an increase in allowance for doubtful debts. Allowance for irrecoverable debts. And in some, that's because we have underestimated the amount. And in some years, you'll have decrease in allowance for irrecoverable debts. That's because we have overestimated the amount. So we need to decrease it. Okay. So accounting policies which are chosen should be applied consistently every year. So where there is no accounting policy provided, then the directors should use their own judgment, rational judgment, as to what's the best way to treat figures using the most suitable manner. Okay, of course, they need to check with the auditors and see whether the method that they choose is viable or not. Can it be accepted? Can it be used without prejudice? Okay. So an entity must apply accounting policies consistently, okay, as I mentioned just now, for similar transactions. That does not to say that we can't change them. We can change the accounting policies if the change is required by a standard or interpretation, or if the changing results in the financial statements being more reliable, then we can change, of course, with authorization. An example, let's say a company has a motor vehicle, okay? The company plans to use the motor vehicle for 5 years. Now, let's say that after the third year, the car meets with a very bad accident. Of course, it was sent for repair, but then even repair, the car still cannot perform as good as before it met with an accident. So technically, this happened in the third year. So technically, we got 2 more years to go, right, under the original plan. But if it is necessary to accelerate the depreciation for 1 more year, then we can change the depreciation calculation. Of course, after agreeing this with our company auditors. Okay. So according to IAS 8, accounting principles refer to concepts that apply to almost all financial statements, like, all the accounting principles that you've learned. And accounting basis, these are methods or ideas developed for applying the accounting principles, right? So the reason that we have accounting basis is to reduce as much as we can ambiguity. Okay, we want to make the figure reliable and acceptable to as many people as there are. Okay, so they are intended to reduce subjectivity by identifying and applying acceptable methods. So that's why, for example, when you calculate inventory, you have to use the approved or accepted methods, either FIFO or FCO. Yeah, you cannot use some other magic formula saying that that's reliable. No, unless it's being approved by the international accounting standards one day. Yes, that. But other than that, we should only use whatever is available or mentioned in the IAS. Okay. Now, IAS number 8 also deals with mistakes. I mean, how do you deal with mistakes? When we find that some errors have happened within the financial statement, we need to correct them. Okay. The standard also provides guidance on the effect of errors on financial statements. So errors are defined as omission or misstatement, right, in the entity's financial statement, and this could affect one or more prior periods. Okay. So the general principle is that the entity must correct material errors from prior periods in the next set of financial statement. That means, for example, let's say our financial year end is January to December. And during the year end 31st December 2022, there was an error detected. And by the time we detect the error, we already closed the accounts. So this thing went undetected. So we need to do the adjustment for this error in the next year. That's what I think. Okay, this material. So thus comparative amounts from prior periods must be restated, subject to the practicalities. Okay, so right. So far I've covered IS 1, 2, 7, 8. Okay, now I'll just talk about IS number 10. And after that, in a separate video, I'll deal with the 4 ISs. Yeah. So IS number 10, events after the reporting period. Okay, so moving on to IS number 10, the title is Events After the Reporting Period. So the reporting period refers to the current financial year, right? Okay, so here what happens is once the accounts have been completed, normally within 3 months of the financial year end, the company will hold their annual general meeting. Okay, so this is where shareholders gather around and they talk about the current year's happenings, and shareholders will have questions to ask and so on and so forth. Okay, so this IS number 10 deals with events. So basically we have two types of event. One is called the adjusting event, and the other is called the non-adjusting event. Okay, so okay, what are they actually? Now, for example, let's say the financial year end is 2023. So we have January, okay, so this is the year 2023, and our accounting period is from January 1st, 2023 until December 31st, 2023. Okay, so obviously the next year is 2024. Now I said, so this is our year end. So I said that normally about 3 months later, we will have the AGM. So again, January, February, March. Okay, so this is, of course, you have April and all that, but I'm just not looking beyond March. So this is year 2024. Okay, so as mentioned, there are two types of event, adjusting events and non-adjusting event. Now, adjusting events are the event happens between the year end and let's say the AGM takes place in March. Okay, the event happens between the year end, that means after we close the year, and the AGM. All right, so an example is, let's say a major customer goes bankrupt, so cannot pay us. So to us, that would mean that we need to incur irrecoverable debts. Okay. So the question is this irrecoverable debts an adjusting event or non-adjusting event? Let's look at the definition first. Adjusting events. An adjusting event is defined as an event after the reporting period, meaning the event happened after the year end, that provides further evidence of conditions that existed at the end of the reporting period. So which means the event is connected. In this case, the event is the customer going bankrupt. Okay, this is connected to what we had by the year end. So we cannot have an irrecoverable debts without creating a trade receivable. That's the key point. So question is, when did the trade receivable exist in our books? Is it within our year end? So within year end means any time between January to December, or is it something which came in after December, maybe in January or February? So if this irrecoverable debts is from a trade receivable which existed in our books within our year end, although this happened after our year, we need to adjust for it, which means we need to pass the entry debit irrecoverable debts, credit trade receivable. Okay, so examples of adjusting event: the settlement after the SOIP date of a court case that confirms that a present obligation existed at the date of the statement of financial position. So, for example, as at the year end, the company entered into a court case, right? And maybe the company lost, for example, so they have to pay. Now, if the case existed after the year end, then you do not need to adjust it this year. It falls under next year. But if the settlement was done after year end, but the case itself started during the year end, then it's an adjusting event. Okay, so here are examples of adjusting event. Okay, the determination of after the date of SOFP of the purchase price or sale price of a non-current asset bought or sold before year end. So sometimes you want to buy or sell non-current asset, and if this happens after the year end, let's talk about selling. If you want to sell a non-current asset and the sale took place after the year end, but the asset that we're selling existed during the year end, then you need to adjust. This is an adjusting event. Although the transaction date is next year, but it comes under this year's transaction. Okay. All right. Okay. Non-adjusting event, on the other hand, is, okay, let's read the definition. Event after the reporting period. Both non-adjusting and adjusting happens after the reporting period. Okay. But non-adjusting is where events after the reporting period that is indicative of condition that arose after the end of the reporting period. That means, for example, if I say that a customer went bankrupt, okay, here maybe in February, but this customer only came to our books in January, which is after year end, then you don't need to adjust. But you probably need to include as a note to the financial statement, because we are reporting to the shareholders. We need to tell them, look, in the next year, we're going to write off some irrecoverable debts. It won't be reflected in this year's accounts, but next year. Okay, so that's basically adjusting and non-adjusting events. So under this subject matter, dividends proposed has been decided as an non-adjusting event. So that's why I told you earlier that dividend proposed, there's no double entry, but rather we show as a note to the financial statements. Okay, so here are some examples of adjusting and non-adjusting event. And the answers. So for example, ABC PLC has prepared its financial statement for the year ended 30th June 2014. So during August 2014, before the financial statements have been approved, the following issues arise. You see, the financial year end is 30th June. But during August, that means before the AGM, the following events happen. Number one, the company informed that a customer has been declared bankrupt. owing ABC 8,000. So the debt related to a sale which took place in January 2014. So January 2014 is within our year end. So although the customer became bankrupt after our year end, but the customer existed in our books in the form of trade receivable during our year end. So this is an adjusting event. It is thus an adjusting event. So we need to pass the entry to write off the 8,000. Okay. Number two, the directors are told that an error in preparing the financial statement resulted in revenue being understated by 50,000. So while preparing the financial statements, well, that's obviously during the year. So there's a mistake. So we need to adjust for it. So therefore, that's also an adjusting event. But look at the third one. A fire at one of the company's properties resulted in damage estimated at 125. Okay, this is special case. Things like fire and all that, floods, is normally a non-adjusting event because otherwise people will abuse it. They purposely fake a fire and say that they need to adjust the books. So fire and all that is non-adjusting event. It is not evidence of a condition that existed at that date. Okay, so this is a non-adjusting event. All right, so the remaining IAS I will cover in a separate video. Okay, that's all for today. Thank you.